It's often useful to gauge sentiment in markets, and a great way to do that is to look at fund flow data. That's how much money is flowing into a fund and out of a fund. And that tells you which particular themes, sectors, or countries are particularly hot right now. Now, that doesn't tell you whether they'll perform well in future, but it does tell you what other people are thinking. So let's look at flow of fund data for the largest US exchange traded funds in a bit more detail. Now, to a certain extent, money simply chases recent returns, and I can illustrate that really well with Cathie Wood's ARK-K fund. So in this top panel that you can see here, that's the price of ARK-K. And you can see that in 2019, it was a pretty atrocious year for ARK-K, which was effectively flat. And in the bottom panel here, the green bars show inflows into ARK-K, and the red bars show outflows. And during that period of low performance, you can see that the net flows into the fund were pretty small. But then in 2020, there was the Pandemania rally, which truly favoured the type of stocks which Cathie Wood likes. And with the large returns for her fund came huge inflows. But then in February 2021, those stocks fell out of favour, and that kicked off a period of underperformance for Cathie Wood's stocks, but also a switch from huge inflows to outflows for the fund. So now let's take a look at a snapshot of flows over the last month. So in this plot, we're looking at flows on the x-axis, so that's how much money is flowing into the fund, with large inflows here on the right and large outflows here on the left. And we're looking at returns over the same period here on the y-axis, with negative returns here at the bottom and positive returns here at the top. So the top right sector here is exactly what we just saw with ARK-K, which is people chasing return. So these are funds which have had high returns over the last 4 weeks, but also had money flowing into them. And it's important to understand that the funds themselves don't drive those returns. So if we were to think about causation, it's actually the returns which drive the flows rather than vice versa. Then in the bottom left here, we've got outflows and negative returns. So these are kind of like rats leaving a sinking ship. And it's precisely the kind of behavior which I try to discourage, which is selling when prices fall. Up here is what I call taking profits. That's funds which have seen positive returns, but where there are outflows right now. Now that could be because people think, well, the returns have been very good for this fund, so now I'm going to sell it and take my profit. And that would be because they don't think the price is going to rise much more. Then the bottom right sector I've called Contrarian, because these are funds which have had negative returns, but where money is flowing into the fund. So this might be because of a recovery that people expect, or it could be people hedging, as we'll see. Now let's start off with that Contrarian sector where we've got inflows into funds but negative returns. So if we zoom in on that bottom right sector, you can see CraneShares K-Web Fund, which is the CraneShares CSI China Internet ETF. And this has taken a particularly big hit in terms of returns, although over the last month it's only fallen by about 4%. But if we look at the flows into that fund, it's grown by about 15% over the last month. So clearly people are still putting money into it despite its massive price fall. And here's the price of that fund since the beginning of 2019, and you can see that precipitous fall which kicked off in February of 2021. I think what this shows is that people simply haven't given up on China as an investment, because this fund is dominated by stocks like Alibaba and Tencent, which fell foul of the Chinese government. So perhaps these companies are poised to make a comeback, and their earnings growth is going to justify much higher prices in future. Now, another group of funds in this bottom right part of the graph suggests that sentiment isn't particularly positive right now, because these are volatility funds which gain in value when equity markets crash. And these are being bought as a short-term gamble that crash is going to happen pretty soon. The reason why you wouldn't hold these funds for very long is that they have a negative carry. If we look at their prices since the beginning of 2021, you can see that there's a gradual decrease in value. And that negative carry is because of the shape of the futures curve for VIX. But if there is an equity market crash, And you can see there was a bit of a blip at the beginning of the year. Then you can see that these funds spike in value. So two of these funds are linked to volatility. That's UVXY and VXX. And the third one is simply short the Nasdaq. So that's SQQQ. So all three of these suggest that negative sentiment is still out there right now, and that some people in the market are now bracing for a crash. If you want to keep up to date with markets, why not sign up for our free weekly market roundup? It comes out on a Friday, it's very punchy, and it just focuses on the important stories. If you want to learn more about that, just click on the link beside me or in the description below me. So now let's start to think about those return chasing funds, and nuclear and solar energy funds are seeing inflows right now. So this is the top right part of the graph, the return chasing part of the graph, and this red ellipse highlights those three funds. Two of them invest in companies which mine uranium, and the third one is the Invesco Solar ETF with the brilliant ticker TAN. Now, we've recently had the COP26 meeting in Glasgow, and I think it's fair to say that many investors are thinking about this energy transition as we move away from fossil fuels to energy generation which doesn't emit CO2. And it's likely that nuclear energy will play a large part in that transition. So, for example, France has announced that it's going to try and sell its mini nuclear reactors internationally. And the UK has also recently announced that Rolls-Royce is going to build its own mini nuclear power plants. Now, these power plants will require uranium, and there are very small numbers of uranium mines globally, so that should favour uranium miners. Now, in 2020, about 79% of US energy generation was from fossil fuels, and renewable energy only made up about 12% of US energy sources. Of that 12%, only 11% was solar energy, but it may be that that's about to change in a very radical way. The US Department of Energy put out this tweet in September announcing a report called the Solar Futures Study, in which they suggested that the US energy mix could switch to 40% solar by 2035. And if we look at the planned photovoltaic generation in the United States, you can see that that's on a steady upward trend. But it's certainly going to be a big step for the United States because currently only 3% of their energy comes from solar. Another two popular sectors are transportation and home builders. So let's start off with transportation. If we look at the sector composition of that Spider S&P transportation ETF, this is how it looks. So trucking, airlines, and air freight and logistics make up the bulk of the fund. So this is very much a recovery play after these three sectors took a hit during the pandemic. If we look at the number of air passengers flying per month in the United States, just before the pandemic, that was at about 80 million people per month. That effectively fell to zero at the height of the pandemic, and it's kind of recovered in two steps. It's certainly not back to where it was yet, but it is recovering very rapidly. So you can see the justification for buying that ETF. And the surge in imports which we've seen in the United States, and here we're looking at the goods imported to the US on shipping containers, that's going to benefit transportation companies. So certainly that transportation sector is seeing good returns at the moment, and it's still seeing inflows. Another sector which is popular is home builders. Following the very sharp fall in the number of houses being built in the United States in 2020, you can see that the numbers eventually bounced back. However, I think they were being held back by very high lumber prices, but those have now fallen, so that should provide a bit of a boost to new housing starts. The other factor which is in the home builders' favour is that house prices are rising very rapidly in the United States. So this combination of more houses being built with higher prices is going to favour that sector. Two other popular themes at the moment are funds which benefit from inflation and rising interest rates. So for example, INFL, which is the Horizon Kinetics Inflation Beneficiaries ETF, is both seeing inflows and seeing reasonable returns over the last month. Now this is an equity fund which uses these criteria beneath me in order to choose its equities. And the idea is that these are companies which can kind of shrug off high inflation. For example, it would be companies which have pricing power such that if their input costs increase, they can pass that on to their customers, so they won't take a margin hit. Or it could be that they have low capital requirements. So for example, this fund contains many financial exchanges which don't require many physical inputs. A high yield fund, which is currently popular, so that's junk bonds, is FALN. That's the iShares Fallen Angels Fund. Now, a fallen angel is a company which has been downgraded from investment grade, that's a rating of BBB or higher, but it's fallen on hard times, probably because of the pandemic, and it's been downgraded to junk bond status. So you could think of these as companies which could make it back into the investment grade space, in which case their price would probably rise very sharply. And certainly if you look at the price action of those funds relative to other junk bond funds, they certainly have been very resilient so far. So this red line is the Van Eck Fallen Angel Fund, the black line is the iShares one we just saw, and the green line here is the investment grade tracking fund LQD. So both of those Fallen Angel funds have outperformed investment grade quite substantially so far this year. Now let's consider the funds which are seeing outflows. And that's a combination of people who are taking profits, in other words, the returns have been positive but they're still selling, or the returns have been negative and they're selling. And there's only one fund in that sector. If we look at the prices of those funds over the course of this year, you can kind of see why those people are getting nervous about the very strong returns they've seen. A lot of those funds are leveraged funds which have simply performed very well. So the very beautifully named Gush, which is the S&P Oil and Gas Exploration and Production Fund, which is 3 times levered, that's seen very strong returns of over 200% this year. Another popular theme this year was chip manufacturers. So for example, SOXL, which is a 3 times levered semiconductors fund from Direction, has seen its value double this year. Another interesting set of outflows is from TQQQ, which is a levered Nasdaq tracker. So clearly some people think that that Nasdaq rally which we've seen doesn't have further to run. But the ProShares Short ETF, which actually loses money as the S&P rises, clearly hasn't had great returns this year. So that's down by about 14%. And we've seen outflows from that fund. So for those who have been bearish so far this year, it certainly hasn't paid off. So I think the broad story here in the flow data is one of more guarded enthusiasm. It's very much still risk on, but I think people are being more selective in terms of the sectors that they buy, but also we are seeing people take off some of those levered bets because presumably they don't think there's that much more upside from here. So if you do want to support us, remember you can always like this video and subscribe to our channel. That way you won't miss any of our future content. And as always, thank you for listening.